So real estate, is it gonna crash or is it gonna keep going up? What's gonna happen to all the real estate out there in the United States? Well, I think the best thing to do here is to really just look back in the past to 2006, 2007, and 2008, when the Great Recession hit and real estate values plummeted along with your retirement accounts. What similarities are there today that were around back then? I think that's a good starting place, because if we're gonna talk about real estate, let's talk about the good, the bad, and the indifferent. And one of the things I really wanna talk about in today's episode is I wanna talk about how real estate is not just a necessity, it's viewed as a luxury by most people because they cannot afford it. With the price of real estate skyrocketing because there's so much demand and not enough supply, and rents going through the roof, the average rent in this country is almost $1,947 a month. When you factor all that in, how can people afford to live? That's really the question. And I think that's probably something you're looking at. Well, that's what we're gonna talk about in today's episode of What Now? What's next for real estate? So the first thing I want to do is I want to look at delinquencies. But to do this the right way, we got to look at delinquencies in 2008 and delinquencies in 2024, right here, right now. It's actually kind of scary looking at this. Check this chart out. I mean, delinquency rate on loans secured by real estate. Look at 2006 and then look at 2024. It's almost the same thing. Now, some would say, oh, that can never happen again. We can never see real estate plummet like it did in 2008. Well, my question would be, why can't we? What factors are there that would prohibit something like 2008 happening again? Because a lot of the things we must talk about are all there today. Pricing of housing has skyrocketed. It has gone up dramatically. Have you really looked at this? Well, check this article out. So let's talk about house prices. And I've got too much data. Yes, literally too much data. But right here, the average median home price as of right now is about $415,000. So if you think about that, well, that's a massive increase over where housing was pre-2020. Let's not even go back to 2008. The pricing has gone up so significantly. And why has it gone up significantly? Well, let's look back before the pandemic. Before the pandemic, interest rates were low, but then the pandemic hit and interest rates got really low, which means everybody rushed out there to buy bigger houses. And when they did that, it drove the pricing up, and up. So when pricing went up, that was great. People could buy houses that cost more and have a lower mortgage payment because the interest rates were so low. But all of that, plus the easy money policies that the Fed put in place and all the printing of the money, about $5.2 trillion, adds to the dilemma we're in today. Because once the Fed realized we got an inflation problem, and also, just to remind you all, the Fed didn't think we had an inflation problem. First, it was transitory. Actually, first it wasn't a problem, then it was transitory, then it wasn't transitory, then it was a problem, then it was something they had to solve. And they had to slay that dragon, which means they raised interest rates very quickly, which leaves us to where we're at today with a mortgage rate of almost 7%. We were up almost to 9% inflation. And when that was happening, the Fed instantly started jacking rates up, making it a problem for all of you, because now, if you own a house with a mortgage of about 3 to 4%, do you want to sell that house? Even though you can get top dollar, you got to buy another house. And if you're going to buy another house, you're going to buy another house at elevated pricing and another house at much higher interest rates. So most of the people that own homes right now, they're not selling. They're not selling because they know if they sell, they got to move into something else and it's going to cost them almost double, which brings us to the major problem we have right now. So check out this article, and this article talks a little bit about the Fed's continued rate pause. So the Fed has obviously stopped raising rates, and they've also come out and said that they're going to potentially drop interest rates 3 times in 2024. Now, I know the market built in 6, which is why the stock market skyrocketed, but the Fed said 3. So let's just talk about what that means. The Fed's interest rates remained unchanged after 11 rate hikes. and that was from 2022 to 2023. So if inflation is down to 3.2 from above over 9%, that means that we're getting close to the Fed's target of 2%. Now that would be a good thing, right? Yes, it would. But the markets really want the Fed to drop rates really fast because that'd be good for greedy Wall Street. And that would also mean that real estate prices would probably go up, up, and up even higher than they are now. So mortgage rates have decreased. And we know this to be true because the average 30-year rate is 7.07. Now that's down quite a bit, almost 1% since March of 2020. High mortgage rates have reduced home affordability and demand. So because of that, we've got ourselves a problem. So according to this article by real estate mogul Barbara, and you probably know her from Shark Tank,
you are remarkably entertaining. Truly, I firmly believe that you'd be hugely successful if you did a comedy routine. But on this business, I'm out.
I kind of like what Barbara says here. So in this article, she's saying that if they bring the rates down too fast, what that's going to do is it's going to bring in more buyers, because if rates even came down 1%, that makes a ton of new buyers eligible to buy houses at the current median prices. But if that were to happen, that's going to boost competition, sending the already high prices, as she says, lofty prices, through the roof. She said if interest rates come down another point by year end, everybody and their mother-in-laws are going to look for new houses, and the competition is going to be so fierce that house prices will go up even more than they are now. So essentially, she's pretty much telling you that if the Fed acts too quickly on the other side and brings rates down too fast, we're going to have an affordability problem that we don't even know how to comprehend. If you think housing is unaffordable right now, just wait till they bring rates down. And I don't mean to go into another article, but boy, oh boy, is there a lot of stuff on this. So I found this other article, which is kind of the flip side to what Barbara was saying. This article right here is trying to give a prediction for what's going to happen in 2024. And it's saying that mortgage rates and home prices will remain high. Okay, although Barbara said that they're going to go higher, but this one's saying that it's going to slow down. The house prices are going to slow down, and that's going to be based on regional supply. It also says that mortgage rates are expected to stabilize around 6%. Now, Barbara was saying she thinks they're going to go lower than that with 3 rate decreases, but the other problem, which we haven't talked about up to this point, is the foreclosure activity. The foreclosure activity is on the rise. Remember earlier I mentioned the similarities between 2006 and 2024? Well, another similarity is foreclosures and the uptick in the number of foreclosures that are happening month over month. We've got an article all about that too right here. And this one talks all about how many houses are going into foreclosures. So there's foreclosure filings that happen, and they're up 5% from a year ago and up 10% from the prior month. So lenders repossessed 3,954 U.S. properties through completed REOs. And that's as of January 2024. So if we really look at foreclosures and we look at this article, we're up 1% from a year ago, which isn't something that really throws this into, oh my God, what's going to happen? But up 1%, that is followed up by 13% increases from last month. The first month-over-month increase in completed foreclosures since July of 2023. And if we take that back and we look at 2007 and foreclosure rates there, yes, they were a lot worse, but we could just be seeing the beginning stages of a similar situation. The bubble might just be about to burst.
Charlie, that really hurts!
And if you look at this article, which was put out in 2007 by Reuters, this one says that more than 1% of all households faced foreclosure during 2007. That's almost twice the previous year's rate. So I don't think we're quite there. But what I'm trying to do is compare then and now. Because this is what now, what's next? Well, we know what now is, but what's next? Is it going to be what Barbara said? Are we going to just see pricing go through the roof because the Fed drops rates? Or are we going to start seeing a slowdown in the increase in prices? And with a slowdown, are we going to start seeing these foreclosure rates tick up higher and higher? And eventually it's like a domino effect. It goes faster and faster. You've all seen dominoes. One goes down and all it sounds like is, and then it's done. Yes, it happens incredibly quick, which is why I'm going into all these articles, because all these articles start to tell a story that we must pay attention to. Because if we just blindly go into real estate as investors or even homeowners, I think we're facing unknown consequences. And those consequences are going to be one of two things. Either people aren't going to be able to afford housing, and then you're going to be stuck in your house if you're trying to sell it, or the flip side, your house isn't going to be worth what it's worth today in the future, which from where I sit, that's what I see. But I see that because I see something that no one else seems to be talking about: unemployment numbers going up. I see the economy slowing down. Matter of fact, I don't just see it, I see the data that supports the economy slowing down. And as the economy slows, what also will follow is job losses. Job losses will go up. Unemployment numbers will start to tick up, and they will go higher and higher. And when people lose their job, I can tell you the next thing that's going to happen. Foreclosures are going to start going up. You're already seeing this happening. Okay? You saw this back in 2006, 2007, even before the Great Recession. These numbers were ticking up just like they are today. So if we just ignore the past and we ignore the signs, then we are literally walking ourselves right to the edge of the cliff, and some will go over the cliff and they won't even know they're falling until it's too late. So what is the solution? What would I suggest everybody does? Well, be cautious. If you're a real estate investor and you're flipping houses, great. Keep it to simple flips. Don't get into really big, overdone, total renovations, because you don't know when the market's going to flip. And if it does flip too soon, guess what's going to happen? Well, just look at the past. What happened to all the flippers in 2007 when the Great Recession hit? They were bankrupt. You don't want that to happen. So if you're flipping houses, be very cautious. Okay? If you're buying a primary house right now, make sure it's your forever home. Now, I know there's no such thing, but try to make sure it's a house you plan on staying in for quite a while, because you might get caught up in a declining price, so that when you want to move out of that house into another one, you may not be able to sell it for the same price you paid for it, because you're buying high. And not only are you buying high, you're buying high at a high interest rate. So your price for that house is going to be really high. Well, how high? I have that data too. So check this article out right here. This is by Yahoo. And this basically says how much money Americans need to afford a starter home. This is alarming. So it says that an American would need a minimum of $76,000 to afford a starter home. And that right there shows you the increase, because that used to be $40,500 that we needed to earn to afford a starter house. But when you keep going on and you look at what an average US worker makes, now I know this is just an average, some of you make significantly more, but the average is $66,000 according to this article. Now Redfin confirms that in order to make a house affordable, it has to be roughly 30% of your income. So your mortgage would have to basically come in at right around 30% of income. And that's assuming 3.5% is put down. Now, we're going to talk about that down payment thing, but let's just talk about 30% of income. So if the average mortgage at today's interest rates is just a smidgen over $2,600 a month, who can afford a house? Well, I don't know. How much do you make? Some of you are thinking, oh, I make plenty of money. Well, that's great that you make plenty of money, but you might live in a place like San Jose, where to afford a house, you're going to need to make $319,000. But hold on, it gets even better. But in San Francisco, you got to make even more than you would in San Jose. So where does it stop? Well, it stops when you go beyond a starter home. And in this article, it basically says that the average American needs to make over $106,000 to afford a comfortable, typical home. I didn't say a mansion, not a big house, a typical, comfortable home, not a starter home. You got to make $106,000. So that means that housing is more of a luxury now. So that's why you're seeing so many apartment buildings being built. And when you look at the stats for apartments, there's a big reason for that. Apartments and housing is a necessity. But if people can't afford to buy their house and they view buying a house, especially when you look at millennials or any of the newer generations like Gen Z, they're not even looking at home ownership. They're looking at renting. But rents have gone up significantly. The national average rent has increased by $1 in January to $1,958. Aha, you were like, oh, it only increased by $1? Yeah, no, it increased to $1,958. And that means they're up 29%. Well, that leads to another problem. So if people can't afford to buy a house and they can't afford to rent a house, what are they gonna do? Well, why don't you just squat? That's right, find your neighbor, find somebody down the road and just move in, just squat. Yeah, I know you're thinking that this is a joke, but this isn't a joke. Check this article out by ABC News. So there's a huge increase in problems when it comes to squatters. And what is a squatter? Well, I can tell you firsthand. It's when somebody moves into a house you own and they don't move out. Oh, and they don't pay rent. So they literally eat you out of house and home. I mean, this is a major issue, and states like Florida have actually realized this is a problem, and they've come up with laws that basically help people get rid of squatters. Yeah, you actually need help removing a squatter. You can't just tell the squatter, get out of my house or I'm gonna do something. No, no, no. You actually have to go to court, you have to evict them. Yeah, they're not a tenant. Well, they are a tenant, but they don't pay rent and they're not supposed to be there and there's no lease, but you still have to evict them. Current laws make it really difficult for owners to swiftly address squatter issues. And I'll give you an example. During the pandemic, I had a squatter move into one of our rentals. It literally took me a year to get the squatter out. And it wasn't because I got the squatter out by going to court. Oh no, no. I got a call from the neighbor the one day that said that the squatter person had gone out on a drug run. That's I guess a normal thing that happened. And when they left for their drug run, what I did is I sent a crew over there with a bunch of plywood and we boarded up the doors and all the windows. And I mean, we really boarded them up. The neighbor calls me back and said that squatter is scaling the back of your house because the only window we didn't board up was the attic window 2.5 stories up. And she almost made it in there. But anyway, that's how I got rid of my squatter. How are you gonna get rid of the squatter that moves into your basement? Well, if you live in states like New York or California, I guess the only way is go through the court systems. But you see, in states like Florida, they realized this was a big problem. So what they did is they passed a law imposing criminal charges and penalties on squatters. I can't believe this is where we're at as a society, where literally somebody can just move into your house and you really can't get rid of them unless you live in Florida. But there's so much that could be said about that one. And as we get to the end of this episode on whether or not real estate's gonna go up, down, or remain the same, I think it's important to realize that we are in an election year. And I also wanna bring it back in time to 2008, which was also in an election year. So when you're looking at this year, 2024, being a very controversial election year, you have to factor that in one way or the other. So I would say in 2024, the markets are gonna remain pretty unchanged. Housing prices will probably remain somewhat unchanged, maybe go up in certain parts. But once the election's done, all bets off. Just like 2008, if you can remember 2008's election, that was also a controversial election. But it was a controversial election that once it ended, the Great Recession hit. And then it was blame everybody else. I think we all can see the path through this. The path through this is a path of you being cautious, a path of you knowing what to do and what not to do. If you're buying apartment buildings, great. Make sure that your apartment building has some things built into the pro forma if rents go down. And also if the price of your property goes down, because that's more than likely going to happen. So if you buy an apartment today, in a year, 2 years, 3 years from now, there will be a very strong probability that you will not be able to sell that apartment building or that house for more than you paid for it. And there's a very strong probability that rents will be lower than they are now. So if you're an investor buying rentals, factor those in. I would say even as much as 15 to 20% drops, just to be on the safe side. Now, if you're buying your primary house, I already covered that. make sure it's your forever house. Make sure you realize that in the next few years, there's a strong probability you won't be able to sell your house for more than what you paid for it. But there will be a strong probability that if you locked in an interest rate today at 6 or 7%, you'll probably be able to refinance that at a lower interest rate in the future because the Fed's already talking about dropping those rates. So it's a double-edged sword. And that double-edged sword really should be one that you look at the pros and the cons of that. Because if, like I said, national rents are at $1,958, it is still cheaper today to rent than to own a house. And not only that, mortgage rates are forecasted to be lower in the future than they are today. But the one thing none of this information talks about that I brought up earlier is unemployment. We lose the economy, we then lose the stock market, and most people will lose their jobs. And if they lose their jobs, they're not going to be able to pay $1,958 a month in rent. They're not going to be able to keep and maintain that current mortgage payment that's over $2,600 as of today. So foreclosures are going to go up. That's what will happen. Now, who am I to say that's definitely what's going to happen? Nobody. Nobody at all. But that's one of the things I think you need to be factoring into your decision when you're looking at real estate and where it's going to be in the future. So with all that being said, I think one thing you should be doing is getting in a community of people that maybe know more than you do, or a like-minded community where people are doing what you want to do. Might I suggest this right here, privatemoneyclub.com. It is like a dating site for money. People with money meet people that need money for their real estate deals. And all of these people have been in the game for a while, and they've been around this campfire for a while. So I think if you need to learn a little bit more, just go over to privatemoneyclub.com, create a profile, it costs absolutely nothing, and get around people that are smarter than you are. And hey, if you're the smartest guy in the room, we'll get in there as well. Teach someone something. Hey, with all that being said, I've gone through a lot of information. I mean, look at all this. Come on, it's just like falling out of the sky. These are all articles that I put together. So I got a favor to ask. Right here, click this subscribe button. And also there's a little bell up top. Whoa! And what I was trying to say is just click that little bell up top. Don't kick it unless you've been doing your stretching and your yoga. Well, as we come to a close, I hope you got some information out of this, and I hope you make some good decisions when it comes to real estate, because all this data, well, it's just data, and it's pretty freaking boring. So thanks for joining me for another episode of What Now? What's next for real estate? See you on the next one.